How safe are these hard money loans and what are the risks? There are risks with any type of investment. There are also so many ways to reduce the same risk. It's your job as an investor to weigh the risks and rewards of any particular type of investing and your individual goals before jumping in. I believe hard money lending is the single safest investment strategy in the country, but we also believe in disclosing everything that is negative to the investors so that they can make an informed and intelligent investment decisions. For that reason, I want to outline many of the risks associated with hard money lending. The first is the mortgage loans are high risk obligations. Borrowers who are obligated under our hard money mortgages, deeds of trust or real estate contracts at times be persons who may not actually qualify for bank financing and can generally be regarded as high risk borrowers. Additionally, hard money underwriting standards and procedures are much more lenient than conventional lenders. The combination of these factors creates an increased risk of default in payment of the obligations, which is why the value of the collateral is so important to the hard money lenders. That is why we lend in areas that we are very, very comfortable with. Second, investors may have difficulty protecting their rights as a secured lender. Properly prepared loan documents will enable investors to enforce their lending agreements with borrowers. However, the rights of borrowers and other secured lenders may limit the investors' practical realization of those benefits. For example, a foreclosure is often subjected to delays due to litigation, and although there is some non-judicial foreclosure options in states like Arizona, it's generally quick. The collateral also may deteriorate and decrease in value during the delay in foreclosing on it. Any redemption rights in foreclosure proceedings can deter the sale of collateral and can, for practical purposes, require the lender to manage the property at an additional expense. In some cases, the lender may not be able to pursue deficiency judgments after foreclosing on the collateral. If, let's say, a borrower files for bankruptcy, it will further delay the foreclosure. If the collateral for the loan is an out-of-state property, it may be more difficult and expensive to evaluate value, enforce the mortgage liens, or conduct foreclosures. Defaults on the mortgage loans may decrease revenue and increase costs. Any failure of a borrower to repay a loan or interest on a loan will reduce the revenue to the investors from the loan and the value of the loan as a whole. Also, in the event of a default, an investor may find it necessary to advance additional funds in order to protect his interest in the property. Maybe they'll have to maintain it. Example of events which might require additional amounts include payment of costs due to foreclosure, including if there are any attorney fees or court fees, and payment of past due real estate bills. Let's say there are utility bills, homeowners association bills, or insurance for that property, and payment for costs to maintain or improve the property prior to foreclosure sale are also some of the factors to consider. Most of the mortgage loans we make will have a balloon payment. Most hard money loans offered through our underwriting practice, we have typically 6 to 8 month balloon payments. There are no specific criteria used in evaluating the credit quality of the borrowers for mortgage loans requiring these balloon payments. Due to these balloon payments coming in the future, a substantial period of time may elapse between the review of the financial statements of the borrower and the date when the balloon payment is due. As a result, there is no assurance that a borrower will have sufficient resources to make a balloon payment when it is due. Another risk is the value of the property securing a mortgage loan. It cannot be bulletproof 100%. Investors will depend on the real estate security to protect them. Our lending practice depends upon the skill of independent appraisers and real estate agents to verify the value of the security underlying the mortgages we write. We may make mistakes, or the value of the real estate may decrease due to subsequent events. As a result, there may be less security in the collateral than anticipated at the time the loan was originally made. If there is less security and a default occurs, then investors may not recover the full amount immediately on their investment. Another risk associated with the ownership and resale of the foreclosed property. If an investor acquires ownership of the real property, he or she will be subject to the risk inherent in the ownership of the real property, including fluctuations in the property values. There could be environmental issues, third-party liability for injury of people visiting the property, repair costs, maintenance costs, legal fees, property taxes, HOA fees, insurance costs. Could be lower occupancy rates in the area now after you foreclose, some operating expenses, and just some variations in the rental schedules. Another issue is there could be a defective title to a property that could reduce the investor's return on their investment. We always do get title insurance. The title to the real property securing a mortgage loan purchased by the investors sometimes could be defective. While the investor's interest in the real property will be insured by the title insurance policy, they might not cover every possible defects of title, and such defects could adversely affect the market value of an investor's security. And all these loans are not guaranteed by a government agency, so do not expect any bailout money. These private mortgages are not insured or guaranteed by a federally owned or guaranteed mortgage agency. Consequently, the only recourse if there is a default is to foreclose on the property.